Hello there. I hope that you're doing well. Welcome to the fifth and final episode of the swing trading series for my 2025 mentorship. During this episode, I will summarize everything which I shared prior during this series and I will provide you with a rule-based system which you can follow in order to form your swing IDs. First of all, let us take a look at the intra-week trading framework. In order for us to determine whether or not the intra-week trading framework is in play, we must first determine key levels based upon weekly and daily charts. These key levels are time-based liquidity pools of bigger time cycles, and next to that, you must determine weekly and daily arrays. What I mean by this is the following. You must determine where the higher time frame, breakers, imbalances, etc. are. Because based upon the reactions to these time-based liquidity pools and these higher time frame arrays, you're able to gauge the order flow and you're able to determine whether or not price is bullish or bearish. Utilize weekly, daily, or session SMT to confirm reversals. This means that we're going to be paying attention to SMT relative to weekly highs and lows, or daily highs and lows, or session highs and lows to confirm market reversals. If you do not understand what SMT is yet, I highly suggest you to go back through my mentorship's content and investigate the topic of SMT. The reason why I'm not going to explain it in depth during this episode and throughout this whole series is due to the fact that I'm speaking to someone who has already gone through the majority of my mentorship's content. And that is what I warned you for throughout the beginning of this lecture series as well. This lecture series is not meant for a complete beginner to just watch and think, okay, this is it. Nope. This lecture series is meant for the person that has already gone through the 2024 model series and has already gotten a good foundation when it comes to everything which I teach. I want you to focus on the days with high impact news. This means that you're either going to look for opportunities on the days with high impact news, or you're going to look for opportunities on the day in advance of the high impact news. And I will explain that by utilizing the following example to you. Let's say that you see the market reach a point of interest on Wednesday. And you know that on Thursday we have a high impact news driver. On Wednesday you see everything which you need to see in order to confirm to you that a high of week is forming at that point of interest. You see all the signs that confirm to you that the reversal is in place. The moment that we then begin to see displacement towards the downside and you begin to see IPDA tipping its hand to you, that right there is the first entry opportunity. And the reason why is because we're then anticipating that the news will get utilized for distribution purposes, where news won't manipulate, but instead be utilized to distribute towards our objective. The process for the intra-week model. First of all, you must determine the monthly order flow. You must determine where are we drawn towards for the upcoming month. Are we drawing higher or are we drawing lower? Secondly, you must determine the days of interest based upon the economic calendar. This boils down back to knowing what days consist of high impact news or what days we are likely going to see major repricing taking place. Think of events such as the Big Three. Thirdly, when a new week opens, I want you to annotate the previous week's high and the previous week's low. The reason why we do this is due to the following. You must understand that when that new week opens, the first two reference points which we have are the previous week's high and the previous week's low. The reactions to these levels will tell us the story for the upcoming week, because the past week tells us how the upcoming week is likely going to deliver. And that is a crucial insight which you must gain. And when you fractalize this as well, you should smile. Because when a new session opens, you should pay attention to the previous session's high and low. Throughout the week, monitor the reactions of the previous day high and the previous day low. The reactions to these levels will tell you the story for the upcoming days. The reason why is because Monday sets the stage for Tuesday. Tuesday sets the stage for Wednesday. Wednesday sets the stage for Thursday, and Thursday sets the stage for Friday. Based upon the monthly order flow and the weekly profile which we're anticipating, we can anticipate when our opportunities will present themselves. And this boils down back to what I discussed within the Predicting Price series. Determine weekly and daily PD arrays, and based upon the reactions to these arrays, you'll be able to gauge the order flow. Determine the weekly drawing liquidity, the DOL. meaning where's price drawn towards for the upcoming week. If this variable is not clear, it's not clear to you where price is drawn towards for the upcoming week, it means that you're basically just dancing in the middle. And let me tell you something. If you try to dabble in the middle when you don't have any idea of where the market is drawn towards, it doesn't matter what array you use, it doesn't matter what PD array you use, at the end of the day, your trade ideas will not play out. The reason why is because price is just chopping back and forth, back and forth. Whereas, however, when the drawing liquidity is very clear and you are very bullish, for example, then any discount array can get utilized for a long opportunity. So that's a very important paradigm shift which has to take place. Establish the point of interest for a fractal market maker model. Let me explain. What you hopefully have come to realize by watching this series and having watched the 2024 model series is that the approach to swing trading is actually very similar to the approach of an intraday trader. However, where an intraday trader uses the point of interest to drop down into a 1 minute time frame or into a seconds time frame, right? To look for that fractal market maker model from the retracement higher, for example, followed by the expansion lower, that would be that fractal market maker sell model. A swing trader would just enter inside the point of interest. It would enter near the high of that retracement. Think about that for a moment. Do you now understand why I said to you, even if you're an intraday trader, you should watch this series? And I'm telling to you, only 20% of all my mentorship students are participating in this series. Isn't that fun to think about? Isn't that crazy to realize that so many people just look at the label? They look at the label, oh, swing trading, I'm an intraday trader, I have no interest in swing trading, so I'm not going to watch this series. Whilst in reality, they're missing out on all these gems because I'm literally telling to you how to navigate the weekly and monthly order flow. Because once you are able to navigate the order flow on these higher time frames successfully, what is likely going to happen on the lower time frames? It will be easier for you to align yourself with IPTA. Look for manipulation against your drawing liquidity into your point of interest from a key open, whether it be the London session open or the morning session open. Is it possible to trade during Asia? Is it possible to trade during PM? Yes, however, the majority of the opportunities which we are going to look for intra-week present themselves during either London or the morning session. Now, when it comes to the statement of look for manipulation against your drawing liquidity into your point of interest from a key open, what I'm trying to say by that is the following. What you need to understand is that when it boils down to the idea of we have a drawing liquidity, for example, below market price, we must look for a point of interest above market price. Because what will happen is that we will look for manipulation into that point of interest, a run higher, to trap everyone into believing that higher prices are next. This is the engineering of liquidity which is taking place, so that we can then go short against that. We trap buyers into believing a false idea, so that we are able to open up our short positions against that. Then when the point of interest gets reached after that key open, look for SMT at the point of interest. The SMT at the point of interest confirms to you that price is in fact going to turn around and draw towards the opposing side of liquidity. The entry takes place either in the point of interest or the moment a breaker or mitigation block gets created. This breaker or mitigation block can be created on the time frame that you're looking at, but can also be, for example, a lower time frame. However, I suggest to stick to one time frame for execution purposes. And the reason why is because if you try to change it up too much, you're going to notice that one setup is cleaner like this and one setup is cleaner like that. But at the end of the day, you can either just enter at that POI with a wide enough stop or look for that bearish breaker to originate from that POI. In general, I suggest paying attention to the POI and based upon the reaction to that, determining whether or not there's an entry opportunity. If you want to, you can go down into the lower time frames to look for that break or mitigation block. But the issue that you then might find is that you're actually changing from that swing trading approach to that intraday trading approach. Does that mean it's not possible? Now, is it possible to go into the lower time frames and look for that breaker or mitigation block creation and use that as your entry from your point of interest? Yes, it is possible. However, why would you make it harder on yourself instead of just focusing on doing that what is easy and focusing on higher time frames? Risk management. And this right here is a very important slide, so don't skip over this. I suggest using 2% risk per trade when it comes to a swing trader's approach. And the reason why is because with swing trading, what's very important to note is that the frequency of trades is decreased relative to an intraday trader. That means that we're likely going to take less trades on average per week and per month. This allows us to increase the amount of risk per position because we are only going to play in on high conviction ideas. It's the same, of course, for an intraday trader. However, because the frequency of trades is less, we can permit ourselves more risk per position. If in drawdown, decrease the risk to 1% until the drawdown has been recovered. That means that if your idea doesn't pan out and you were wrong about your analysis and you take a stop out, that means that for the next idea, you must decrease your risk to 1% until the drawdown has been recovered. Let us take a look at a visual representation of the bullish intra-week model. Here we can see the open of the new week. What I want you to see right here is that when this new week opened up, we saw the market initially run lower and it draw towards either a previous week's low or a previous day low. This means that we have already defined where these key liquidity pools for sell-side liquidity pools are resting. Next that you can see that we have determined where the key buy-side liquidity pools are, up here. The market drops lower into a point of interest. And this drop lower is so important to note because we are bullish for the week, meaning we're expecting higher prices. So what we're looking for is manipulation lower into that key sell-side liquidity pool, into that higher time frame key level, for example, a higher time frame imbalance, so that we can then see the low of week form in this area, so that the market can begin to expand towards the upside and draw towards the previous week's high or the previous day high. Now, the reason why I've not put in just the previous week's low or the previous week's high is because what I'm showcasing to you here is fractal, meaning you can utilize any time cycle of your choosing. And that right there is the most beautiful level of understanding which you will hopefully get towards one day, where you come to realize that it doesn't really matter what time frame you're on, because time is time and price is price. The only difference between all the time frames is the duration between the time cycles, meaning the duration between the highs and lows forming of the previous cycle. For example, when you're looking at a daily cycle, it of course takes 24 hours to form those daily highs and lows. However, when you pay attention to a 90-minute cycle, what you will notice is that it only takes 90 minutes to form those highs and lows. So what you begin to understand then is that the only thing that's different is the amount of time, but the underlying logic of paying attention to that previous cycle high and low remains the same. Now, how is price different? Well, price is the same when it comes to the creation of the arrays, of course, but the only thing that's different is the size of the ranges due to the volatility on the higher time frames versus the lower time frames. However, what we see is that the market drops lower into that key sell-side liquidity pool. That is our point of interest, which is being reached as well below there. And we then see the market form that smart money reversal before we see the market expand towards the upside. Look for SMT right here inside of the point of interest. This SMT can either be relative to that sell-side liquidity pool, to that previous week's low or that previous day low, or it can be SMT inside the smart money reversal. That SMT inside the smart money reversal would be, for example, just an SMT right here on the absolute lows. And next that what you would be paying attention to is when both apply. If you see both SMT relative to the previous week's low or previous day low, and you see SMT inside of the SMR, this is called double SMT, and this is the strongest form of confirmation which you can have for an SMR being in play. The entry area is anywhere below the opening price right here. This can be the opening price of a week, this can be the open price of a day. What I'm sharing with you right here is that we look to enter below the opening price or at it, just in close proximity to it. And the reason why is because we're buying it in a discount relative to that opening time. And notice that I'm sharing with you that the opening time is up to your choosing, meaning it depends on what you're framing the trade idea on. If you're framing it for a weekly swing, then you would much rather be inclined to use the weekly open, and of course the previous week's low and the previous week's high. If you have, however, already established that you're bullish for the week and that you're looking for a long idea, you can utilize the previous day's low as a level to monitor the reaction of in order to determine whether or not a trade idea is going to pan out and whether or not you are going to see the market draw towards that previous week's high or that previous day high. Here we are on the Nasdaq chart. And what I want you to see is that the Nasdaq expanded above this red shaded box. If we pay attention to the left right here, you can see that this red shaded box was this CB right here on this chart. Notice that the market expanded above it and continuously found support inside of it. It found support inside of that area right here, and right here. Notice that we formed the high of month right here of the previous month and we saw the market drop lower. The new month opens up, and where does the market open up in? It opens up inside of the price range of that old CB. And what you need to know is that when we displace above a CB and we have key buy-side liquidity pools which are still yet to be made jacked, we can anticipate that the market is going to retrace into that price range of that old CB, find support there, and then continue the bullish order flow. What you can see is that the market formed a low inside of this CB again. And what did the market do? It expanded towards the upside. It expanded towards the previous month's high. Why is this previous month's high an important buy-side liquidity pool? Because of the fact that it got engineered in advance of the old autumn high. So you have a monthly high right here. And next to that you have an old autumn high right here as well. So you have two key buy-side liquidity pools that are too close to each other that we can anticipate them to be made jacked. Now, when we pay attention to the RE chart then, what you can see is that on this RE chart, you can see that the market dropped lower into that CB's price range. We see the market just go back and forth there for a while. And your eye might be drawn towards everything around the right here. However, I want you to focus on the delivery which took place on the left. Notice how the market consolidated up here, forming that monthly high. And then we saw the market expand towards the downside. A retracement takes place, and we see two imbalances get created in a row right here. I've only annotated the higher one right here, but notice that there's also one below here. When you see big down close candles on the left side of the curve into your point of interest whilst you have a bullish bias, whilst you have a bullish thesis, what you can anticipate is that these big two down close candles are representing manipulation that are taking place. Meaning you can see that two CBs are getting created and it shows to you everyone is being trapped into believing lower prices are next. We see the market consolidate inside of that CB and eventually we see the market begin to displace towards the upside and we begin to see it run towards buy-side liquidity, resting above the previous month's high and eventually beyond. This was also around the period that President Trump was elected. Now what you can see is that I've annotated the previous week's low which formed inside of that day CB right here. What we will do is we are going to compare Nasdaq to ES. On the left you can see Nasdaq and on the right you can see ES. Notice that on the left you can see that Nasdaq never took out the previous week's low, meaning it created a higher low. However, when you pay attention to ES right here, what you can see is that ES took out the previous week's low and then began expanding towards the upside. That right there is SMT relative to the weekly low, and that confirmed that we were forming a low inside of that old CB's price range, and that means that we're likely going to see the next expansion leg higher taking place soon. When we go back to this chart then, what you can see is that I've annotated the high which formed inside of that CB. Notice that the market repriced above that high right here, and that by itself is already the first entry opportunity. The reason why is because that is IPDA tipping its hand to you, that's in fact in the buy program, after the SMT. That's very important to note. You have framed the idea of a weekly low being inside of that higher time frame array, inside of that CB. You have seen SMT take place inside of that point of interest. After you have already defined that the draw liquidity is above market price at the previous month's high and at old autumn high. So the moment that IPDA reprices above the high which is formed inside of this CB on the left right here, this is already IPDA tipping its hand to you, and that is the first entry opportunity. A stop loss can be placed below this candle's low. Look at the size of this candle. And next to that, what you can see is that an REBC got created right here. If you wanted to wait for the creation of that imbalance, you could have entered right here inside of that imbalance, increase the potential risk to reward on the position, and move from there. Notice that the market repriced above this RECB right here. And notice that when we tapped above it, the market found support inside the price range right here. And eventually we saw the market expand higher significantly, and we saw this imbalance get created. Notice that the market opened low for the next day, for the day of Wednesday, and we saw the market eventually reprice towards the upside. Do you see how this was also a potential entry opportunity anywhere in this area? Where you begin to see that the market reprices away from its imbalance. A new imbalance gets created right here, which I did not annotate, but pay attention to the direction to the midnight opening price right here. Whenever you are trading within a market maker buy model or sell model, within any market maker model, you will see so many entry opportunities, and that is why it's crucial to truly understand them. And when you pay attention to ES as well on the right here, what you can see is that Nasdaq reached that midnight opening price whilst ES didn't, and that right there is open SMT, and that confirms to us that that next expansion leg towards the drawing liquidity is going to take place. So that's a good gem for you in here. Now let's take a look at the bearish intra-week model. The bearish intra-week model is basically the bullish model inverted, meaning what you first of all do when the new week opens up is you must determine, alright, are we bearish for the upcoming month? If we are bearish for the upcoming month, you must monitor the moment that the new week opens up where the previous week's high are and where the previous week's low are. If we have determined where these liquidity pools are, we are going to monitor, is there any higher time frame array above the previous week's high? If there is, that means that the previous week's high is engineered by such liquidity. When price stops right in advance of a higher time frame array, you know that that is the engineering of liquidity which is taking place. And what occurs after that engineered liquidity has been taken out? After that, you're likely going to see all the signs which you need to see in order to confirm that SMR. We see the market run up higher into that point of interest, into that higher time frame key level, and we begin to see the signs of a high forming in this area. Then the market displaces below the opening price, retraces, and we then begin to see the expansion leg towards the opposing side of liquidity. Now again, as outlined, this depends on where you're framing the setup, because if you're framing it from, let's say, the beginning of the week, from Monday and Tuesday, you're going to see the week open high. However, if it's already Thursday and you want to participate in that final run towards your higher time from drawing liquidity, then you could use the logic of paying attention to the Wednesday high, its reaction, and then based upon that, monitor whether or not you're going to see a purge and revert. Everything boils down to recognizing where's the manipulation taking place. Because when you can recognize manipulation, you can anticipate the distribution which will follow. Now, when we pay attention to that same schematic, but I put on the following note, what I want you to see is that we can see that the market has formed SMT relative to the previous week's high or the previous day high, or there's SMT inside the SMR, or there's both. And when there's both, it's called double SMT. And when you see this, all the stars align. And that is where we want to see all the magic come in place, so to say. Because when I see double SMT, that to me is the ultimate confirmation of the confirmation taking place of a swing high formation. Now look for SMT at that exact reversal and look to find your entry above that opening price or in close proximity to it, as you can see right here. Why? Because we're looking to position yourself short in the open high. That is very important. Open high, guys. Now let us take a look at the higher time frames for a moment and let us pay attention to GU. What you can see right here is that I've annotated on GU this specific imbalance right here. Notice that the market expanded lower a lot before eventually forming a low and drawing towards the upside. Notice that we repriced into that imbalance already right here and we saw the market reject it. Notice, however, that this rejection was not sustained, meaning we saw the market eventually form a low and drop back towards that old imbalance. Does that mean we all of a sudden turn bullish? No, we can still utilize that same old imbalance to look for rejections to take place of. Meaning, as long as price does not displace above this imbalance, I'm anticipating a rejection to originate from that same range. Notice that I've annotated the previous month's high right here, and we then saw the market expand towards the downside significantly, originating from that green box. Now, when we pay attention to the RU chart, what you can see is that I've annotated the previous month's high, and what you can notice is that the market repriced into that higher time frame imbalance many times where you can see that they just repriced into it, rejected, repriced into it, rejected, repriced into it, rejected, repriced into it, rejected, etc. What this is showcasing to you is that every single time that price is entering this area, shorts are being filled. And high frequency trading algorithms are doing one thing. They're shorting, they're shorting, they're shorting. They're positioning themselves short for that high time frame swing high, which is likely going to form so that the market can be repriced towards the downside. Market is consolidating, and eventually the month of February opens up right here. February opens high, forms the high right here, then begins to displace towards the downside. Notice that the market displaces through this imbalance which formed right here, and we see this CB get created. We already framed the idea of the market likely rejecting that imbalance from the higher time frames. The reason why is because we haven't seen price displace above it, so we must anticipate, alright, we're likely going to reject it. Price is either going to continue through it, or it's going to reject it. And when it's not showcasing to you that it's continuing, we're likely going to see that rejection take place. We see the market create this CB right here, above the February open, above the new month's open, and therefore we can anticipate that we're likely going to see the market retrace into that CB, and there we are likely going to see that lower time frame sell program unfold from. Notice that the market wicks above the CB, but notice that the body goes below it. This right here is an entry opportunity. The reason why is because we're entering inside of a premium array, which got created throughout the London session. And that right there is a gem. Pay attention to when your arrays are created, during what session or what time. And we begin to see the market eventually roll over. Notice that the stop can be placed above the previous day high, because if we're in fact in a sell program now, and if we're in fact likely going to see GU begin to roll over, what we can anticipate is that we're likely going to see the market begin to draw towards sales liquidity. And in order for that to be the case, when we have already reached a higher time frame array, we're likely going to leave those previous daily highs intact, because there's no need for the market to get back above them anymore, since the order flow has already changed from bullish to bearish, and all the liquidity has already been taken from the higher time frames. We see the market expand towards the downside, and it trades below this down close candle right here. This down close candle by itself is again a potential shorting opportunity. The reason why is because it was a previous week low. Pay attention to the previous week's range from Monday to Friday. Notice that the low of that week formed right here. That means that if we're in fact in a sell program now, we are likely going to see that the previous weekly low function as resistance on price. This is my continuation time cycle theory in action, where you see that the previous X low is functioning as resistance on price once this plays through, which tells us that the order flow is still bearish. If this was not the entry yet, this would have been a potential entry. Stop loss would have been placed either above this down close candle. However, to play it safe, what I suggest doing is going a few pips above that, or even above the February open, and moving it from there. Now, let's say that you took this first entry. How would you manage this? The moment that price displaces below the previous week's low, you can immediately trill your stop loss to break even. Why? Because the next entry is taking place right here, and the invalidation of that idea would be if price would come back all the way up to this CB right here. And that's a very big light bulb moment for some of you which is taking place, because you need to note down in your notes that trade management, yes, is the following. You manage your positions by paying attention to where the next entry opportunity takes place. That next entry opportunity has a new invalidation, which is usually around your initial entry. Now you begin to understand how I'm able to pyramid into my positions. This is something which I will discuss more throughout the 2025 mentorship series, in which I'm going to share with you a full model that allows you to pyramid in and out of positions as well, when it comes to scaling up when times are good and scaling down when IBDA is showcasing to you that things are not as pretty as possible. Now let us move on to the following chart. What you can see right here is that on the left you can see GU, on the right you can see the dollar. What you can notice right here is the following. What you can notice is that I have annotated the previous monthly high on GU inside of that high time frame imbalance. And next that you can see that I've annotated the previous month's low on the dollar. What you can notice is that GU created a lower high relative to that previous monthly high, whilst the door creates a lower low relative to that previous monthly low. This right here, guys, is SMT relative, yes, to that monthly high on GU, or that monthly low on the door, of course, depends on how you view it. Because what should have occurred is the following. What should have occurred is that GU created a lower high, whilst the door created a higher low. But because the door also created a lower low, that right there is SMT, which is taking place relative to a monthly low, and therefore that's a lot of time between those periods of time, and therefore we can anticipate that we're likely going to see the market reverse soon, especially when you consider time and when you consider where we were at relative to price. Now, let us dive into the process for long-term trading. The visual representations of the process for long-term trading are exactly the same as the intra-week trading, but the only adjustment which is being made is what the liquidity pools of course are. However, when it comes to the process, we have some few things which we need to monitor, and those are the following. First of all, we determine the yearly order flow, meaning we determine where the market is drawn towards the upcoming year. This means that we pay attention to very high time frames, and then we can be monitoring monthly time frames, maybe even quarterly time frames or yearly time frames in order to get an idea of where the markets are drawn towards on the highest possible time frames. Next step, we determine longer term narratives being in play. A longer term narrative is basically a narrative that the media is actively trying to push when it comes to changes that are taking place. This doesn't necessarily have to be something which is very well known to the majority of people. However, you must be able to recognize trends. And this is a topic which I might discuss in the future within separate topical lectures, where we can pay attention to swings which are taking place, where you can see that the masses are being led to believe a false idea, while smart money is doing the opposing on the back end. And that is something which we will discuss later down the line. And what I mean by backend, by the way, is behind the scenes. When a new month opens, annotate the previous monthly high and the previous monthly low. This means that the moment that that new month opens, you immediately have those two reference points, just like with that weekly open. Above the previous month's high, buys liquidity has been engineered, and below the previous month's low, sells liquidity has been engineered. Throughout the month, monitor the reactions of the previous week's high and the previous day's low. This means that if the market is not in close proximity to the previous month's high and or the previous month's low, monitor the reactions to the weekly highs and lows to gauge the order flow for this month. Determine monthly and weekly PD arrays, meaning determine where your higher time frame imbalances are, determine the monthly draw on liquidity, the DOL, and next step, establish your point of interest for a fractal market maker model. When you have determined a draw on liquidity below market price, you will be looking for a point of interest above market price. You will be looking for open high into that point of interest. This is trapping people into believing higher prices are next. And then you are going to look for the signs that confirm to you that we're likely going to see the market draw towards the downside soon. Look for manipulation against your draw on liquidity into your point of interest from the weekly open. However, this weekly open could also be adjusted into, for example, your monthly open if you're looking at a position trade for a longer period of time. Look for SMT at your point of interest, because this SMT confirms to you that the market is in fact going to turn around. Entry either in the point of interest or the moment that the breaker or mitigation block gets created. Now, the only adjustment which has been made relative to the intra-week model is the fact that a swing trader that is paying attention to long-term trading is focused on participating in very large price swings, and therefore the duration of the time cycles which he is referring to are also very big, of course. And that is a perspective shift which has to take place, where you begin to understand that everything forms in each other. Meaning, if you're able to establish your higher time frame analysis and you're able to align yourself with that on the lower time frames, you are going to see a level of precision that's unmatched. And that is what I'm interested in when I'm looking for setups myself. I don't really care about going against the higher time frame analysis. Can I? Can I look for opportunities against a bullish bias and look for shorts? Absolutely. However, where do you think the lowest possible resistance security runs are going to take place consistently? On the upside, of course. So why would I look to short against that, right? Focus on aligning yourself. And what I want you to do is I want you to go into your own charts. I want you to investigate everything which I taught you during this series. I will not share with you the schematics for the long-term trading model as separate schematics because they're exactly the same as schematics which I outlined prior. The only adjustment is, of course, that you're paying attention to, for example, a previous monthly high and a previous monthly low, and you're paying attention to just bigger time cycles in general. But besides that, everything stays the same. I'm 130% certain that when you go into your own charts, you're going to be amazed by the level of precision when it comes to these higher time frame swings. And then it's up to you to decide what to do with that information. I want to thank you for watching this lecture series all the way to the end. I hope that you enjoyed it. As outlined, only 20% of my mentorship students are participating in this series. So that means that you are one of that 20%, and I congratulate you for that. Even if you're an intraday trader, I'm sure that you have gotten massive value from this series when it comes to higher time frame analysis being made. And if you ever want to get into swing trading, this is how I would invite you to investigate it. I want to wish you good luck with your studies. I want to wish you good luck with going into your own charts and trying to look for these high time frame swings. If you have any questions, feel free to reach out to me through the mentorship form, and I look forward to seeing your development. Good luck, and I highly suggest you to pay attention to the 2025 model series as well. Be safe.